Okay. The applause will stop as soon as you figure out what I'm going to be talking about, which is the bond market. I'm sorry to let you all down. We're at a FinTech Forum. I know everybody in this audience knows what a bond is, but just a quick show of hands, does anyone in this arena have any idea how the bond market actually works? Oh, we have one amongst the judge. I'm going to get a tough question. I can't see very well because of the light, but it doesn't look like it's very widely known how the bond market actually works in the real world. The bond market is huge, but it also has a huge problem. Bond markets and other OTC markets require intermediaries to facilitate transactions between institutional investors and other institutional investors or even retail investors. It is an opaque market. That's why very few people in this room really know how it works or understand where bonds are trading. It's dominated by manual, humanistic processes. Human traders are typically asked for a price and then respond with a price via something called an RFQ, request for quote. This lack of pre-trade transparency creates a lot of uncertainty around execution, where you can actually transact. Very different than the markets we're all used to, such as the stock market. At the same time, overall transactional volume over the past decade has grown by 150%. There's a lot more debt in this world. And the rise of fixed income ETFs has increased the number of price requests by tenfold over the past decade. Now, with this big problem is a big opportunity. This is a $30 billion a day transactional volume. And in the corporate bond market alone, which is just a portion of the bond market, we've got a $15 million a day market-wide revenue opportunity. So what is the solution to improving this market and dragging it into the modern age? Software. Elefant is a fully operational, AI-powered bond market maker. We call ourselves a smarket maker. I'm also head of marketing. I realize that's not particularly genius, but we do have customers, and we are transacting. 60,000 trades done since launch. 1.8 billion in transactional volume over the past several months. And with our existing client base, we're generating a 4% market share. What does it do specifically? Our software ingests data, like pretty much all software, and calculates optimized prices where we're willing to buy and sell thousands of bonds, always transactable all day long. We take these prices that are generated by our software and we push them to our clients, which are asset managers and retail aggregators, financial advisors, whether through trading platforms or via API directly to the customer. And yes, we hold inventory. I realize the VCs in the room are going to freak out. We hold inventory and we manage this inventory algorithmically such that we minimize the variation in the value of this inventory regardless of market conditions. What are we doing really? The same thing that technology has done in other domains. We're improving transparency, we're adding efficiency, and we're giving our customer base certainty around the ability to execute. Does it work? Yes. We have, right now, as we're staying, even in the early days, we are generating more or less $120,000 in MRR. This is with 28 global asset manager clients, onboarded clients such as Eaton Vance, T. Rowe Price, Janus Henderson, Alliance Bernstein, household names. That's who we transact with. We're generating $650 per million of transactional volume, and our inventory change has never exceeded 0.0014% of value change on any given day. The proof is definitely in the results. As we grow, we project profitability within 2 quarters, relatively stable cost base, and we project $21 million in quarterly revenue by the first quarter of 2022. That's $12 million in EBIT. Like all software-powered businesses, we have a 70% contribution margin and a 55% EBIT margin. We are raising capital right now to fuel our growth. We're trying to raise $5 million in equity. This will get us to an 8% market share over the next couple of years, and we do have significant growth opportunities in adjacent bond markets. We talked about the corporate bond market today, but there's the municipal bond market and European bond markets as well. As you can see by my gray hair, this is not a young man's game. Our senior team has an average of 22 years of experience in this domain. Thank you very much.
Judges,
Oh, no.
I expected the bond market
Here it
expert
comes.
to ask a question.
It's an easy question. What is your regulatory structure? Can you talk about your risk management practices since you do hold inventory? And it's one thing to optimize the price, but you can't force people to transact, and you may end up holding quite a bit of it at a very unfortunate time.
Absolutely true. Couple things. Regulatory, we own a fully owned broker-dealer, so we have a heavy FINRA regulatory construct there, and we also have an investment advisor, so that's the SEC. And we have 5 Series 24 professionals, and I am a certified regulatory and compliance professional myself. With regards to inventory management, the process of managing the risk in our inventory, if you will, is the same thing as creating price. Think of it as a seesaw. Half of our inventory is long, we own it. Half of our inventory is short, we sold it and we don't own it. And as prices go up or down, if you're doing your job correctly, it doesn't affect the net value of your inventory. As you start to buy more bonds, the prices at which you're willing to buy that next bond continue to drop. The prices at which you're willing to sell bonds continues to improve. And you naturally gravitate towards kind of flat. Go on.
Just curious, because in a market, the market will not be always balanced, and I think the times that you don't want to be doing one side, that may be the side that's trading the most. So that's kind of...
So imbalanced markets is the question. What happens when everyone's a seller and no one's a buyer? Or let's say, what happens when there's 5 sellers for every 1 buyer? Because if there's no buyers, then you don't get any transactions. And in that example, what happens is our opportunity contracts. So we look for offsetting activity. So 5 to 1, our opportunity is really the 1 to 1. And so it's a contraction in opportunity rather than being caught left holding the bag, so to speak. Thank you very much. Thank you.